Welcome to our deep dive on the under 22 student trap. Financially independent in practice, but legally dependent on paper. Today we will unpack how a full-time student working 30 or more hours can still be pushed into high-interest debt. And, more importantly, what practical steps can help you stabilize. Let's get started. In this agenda, we will begin with the paradox many working students face, then examine real budget math. After that, we will cover aid roadblocks like FAFSA dependency rules and SNAP student exemptions. Next, we will map the debt spiral and show interventions. Then, we will walk through step-by-step fixes you can try. We will include quick quizzes to check understanding and finish with key takeaways and resources. Let's move to the core paradox. Here is the paradox. You may be functionally independent, covering your own bills and responsibilities, yet the aid system treats you as legally dependent until a certain age, unless you meet narrow exceptions. This can cause tuition support to vanish, while essentials like car insurance, rent, groceries, and specialized service animal care consume your limited income. Now, to understand the scale, let's visualize the budget. Let's quantify a common scenario. After taxes, a student working 30 or more hours weekly at around $15.50 per hour may take home roughly $1,600 per month. Essential and fixed costs, such as car payments and insurance required to commute, rent and utilities, groceries, phone, and specialized service animal care, can exceed $2,150 per month. This leaves an estimated $550 monthly shortfall, which often lands on high-interest credit cards. Next, we will detail a sample monthly budget to make this concrete. This table shows a representative monthly budget. After-tax income of approximately $1,600 confronts essential expenses totaling about $2,150. The resulting negative $550 gap is commonly financed using high-interest credit, which quickly becomes unsustainable. With the budget pressure clear, let's map the spiral and places to intervene. This flowchart shows income meeting a wall of unavoidable expenses. The shortfall is often covered with credit, leading to compounding interest, fees, and cascading consequences like higher insurance premiums due to a lower credit score. However, there are intervention points: a financial aid dependency override, a SNAP student exemption, a cost of attendance or budget increase, emergency grants, and payment plans. These interventions can redirect substantial dollars back to essentials and reduce reliance on high-interest credit. Next, we will break down the aid roadblocks causing the trap. FAFSA determines dependency and often requires parental income until a student reaches the age threshold, typically 24, unless they meet specific exceptions like marriage, military service, being an orphan or ward of the court, having legal dependents, and similar criteria. SNAP restricts benefits for students enrolled at least half-time unless they qualify for an exemption, such as working 20 hours weekly, participating in certain programs, or meeting other exemption criteria. The result is that aid can be reduced or denied based on parental income you do not actually receive, forcing borrowed funds to be used for basic survival. Now, let's check your understanding with a quick question. Question: for federal student aid purposes, at what age is a student generally considered independent, absent other qualifying criteria? Options are 21, 22, 24, and 26. You may pause the video now to think about the answer. Years. We will discuss the answer in the next section of the video. The correct answer is 24. Most students are considered dependent for federal aid until age 24, unless they meet qualifying exceptions like marriage, military service, having legal dependents, or similar criteria. Next, we will discuss practical steps to navigate these rules. When your actual circumstances diverge from what the form assumes, you can request a professional judgment review. This may include a dependency override or a cost of attendance increase. Let's walk through the process step by step. To request a professional judgment review, start by contacting your financial aid office and asking for a meeting regarding special circumstances. Gather documentation such as your lease, utility bills, pay stubs, bank statements, proof that you do not receive parental support, and records of unusual necessary expenses like service animal costs. Ask Disability Services for a letter explaining the essential nature of the service animal. Submit your dependency override appeal with a clear narrative and, if possible, third-party statements. If the override is not granted, request a cost of attendance increase to reflect unavoidable expenses. Set reminders, and follow up weekly until a decision is made. Next, here is a helpful message template you can adapt. Use this concise template to request a professional judgment review. Customize the details, attach clear documentation, and be specific about your requests. Keep your tone respectful and factual. Now, let's pivot to SNAP and how students can qualify through exemptions. SNAP restricts benefits for half-time students unless they qualify for an exemption. Common exemptions include working 20 or more hours per week, receiving work study, being a parent of a young child, meeting certain expected family contribution or student aid index criteria as recognized by state policy, and participating in specific qualifying programs. Apply through your state's portal and be ready to document your hours, enrollment, and the specific exemption you claim. Next, a quick quiz to reinforce these points. Question: which of the following is commonly a SNAP student exemption? Options are: being enrolled half-time with no other factors, working 20 or more hours per week, receiving unsubsidized student loans only, and owning a car. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is working 20 or more hours per week. That is a common student exemption for SNAP eligibility, while the other options are not generally qualifying by themselves. Now let's compare high-interest debt with lower-cost alternatives you can consider. On the left are high-cost options: credit cards with high annual percentage rates, payday or title loans with steep fees, skipping essential payments or insurance, and racking up late fees and overdrafts. On the right are lower-cost alternatives: campus tuition payment plans, small-dollar loans from credit unions, emergency aid funds, insurance discounts through good student status, telematics or defensive driving courses, and hardship programs offered by providers and utilities. When possible, prioritize the lower-cost side to minimize long-term damage. Next, let's plan a short-term stabilization schedule. This 90-day plan begins with 2 weeks of spending, tracking, and listing automatic debits. In weeks 2 and 3, renegotiate bills and inquire about insurance discounts. In weeks 1 through 4, file a dependency override, apply for SNAP, and request emergency grants if available. Over months 1 through 3, build a small emergency buffer, stepping from $100 to $250 and eventually $400, to absorb minor shocks without resorting to high-interest credit. Next, let's visualize the semester timeline. This timeline will depict the semester from start to finish. First, a budget audit, then a financial aid meeting, followed by documentation submission, a SNAP application, building an initial $250 buffer, arranging payment plans, and finally rechecking aid ahead of the next term. The chronological view helps you schedule tasks so they do not collide with exams. Now, a short but important disclaimer. Please note, this content is for general educational purposes and is not legal, financial, or benefits advice. Program rules and policies vary by state and can change. Confirm details with your financial aid office, your state SNAP agency, and qualified professionals. With that in mind, let's move to key takeaways and resources. The key points are to document your circumstances thoroughly, request professional judgment for a dependency override or cost of attendance increase, apply for SNAP using a valid student exemption, use payment plans and campus resources to avoid predatory credit, and build a small emergency buffer to reduce reliance on borrowing. Next, we will provide a concise markdown action checklist you can screenshot. Here is a concise checklist. Gather core documents. Request a financial aid meeting for professional judgment. Obtain a disability services letter if a service animal is essential. Apply for SNAP using a valid exemption. Inquire about tuition payment plans and emergency funds. Contact your insurer about discounts, and begin building a small buffer by saving a few dollars weekly in a separate account. Finally, let's summarize and wrap up. In summary, a mismatch between your financial reality and legal dependency can create persistent shortfalls and debt. Professional judgment reviews for dependency overrides and cost of attendance increases can unlock more aid. SNAP exemptions can free up food dollars, reducing reliance on credit. Plan ahead each semester, build a small emergency buffer, and avoid predatory lending. To close, here's a final note and a request. Thank you for watching. If this video helped, please like, share, and subscribe for more student survival guides. We want to hear from you. Share your story or tips in the comments so others can benefit.